I'm Graham Davies, Fractional CFO and founder of Edition Finance. Today I'm joined by James Collinson, who is the founder of Design Spec, and really excited about this one. As always, I think it's a great business. It's doing some great work, and can't wait to get into the details of it, really, James. So, do you mind giving us a quick 60-second sort of breakdown about your company, what you do, who you serve, and what problems you solve?
Yeah, cool. First of all, thank you for having me on, Graham. Really excited to be part of your journey as well. Design Spec, good Lord, it feels like it's only yesterday, as with I think most people with a business. But yeah, we started primarily trying to help homeowners. So it's families first, fixing the architecture space, because certainly when I was young and was witnessing people coming in and out of a practice, hourly rates and effectively percentage fees was a big no-no for families. They just need to know what they're spending. So Design Spec was born out of that, and we've gone on now. We help 250 to 300 homeowners per year, and it's going quite nicely. We've got a really good team, really good people, and I'm excited to dive into that with you today.
Yeah, that's really cool. I think the fixed fee thing is obviously very attractive for a lot of people, isn't it? So I imagine that's for, like you said, for families, for domestic type work, that's so important to them. They can't have the open checkbook, can they, sort of thing?
No, I think as well, people were very frustrated for a very long period of time. No one really ever sat down and looked at architecture the way that I would argue it should have been looked at. Certainly in other spaces like solicitors, fixed fee in America took off quite quickly, and it became quite common. And even to now, some of those online platforms they have over there are amazing, and that's creeping into the UK as well. There's a lot of solicitors that will work on a fixed fee basis or even give an upfront quote on most legal exercises. But in architecture, it was completely unheard of 10 years ago. It was you may get the odd quotation that was a fixed amount because people really pushed for it, but it was it was certainly not the norm. And then from there, we took that as a concept and wanted to keep rolling with it. So we want to be a one-stop shop for families. So we've then also brought in Design Spec Connect, which connects homeowners to builders free of charge. We've got Q Spec, which will help them with their cost planning, which is effectively a quantity surveying side to our business. And we've actually just acquired two structural engineering companies to also help with the structural element. So yeah, we're doing everything we can to help families from the very beginning to the very end of their journeys.
Yeah, great. And that's obviously testament to the fact that you're doing 250 plus families a year. So that's great. It means it's definitely working,
It's
James.
doing something, right?
Yeah, definitely, definitely. Um, would you mind talking us through like your business journey, like when it started, how long it's been going from inception today, and how that looked? Because I know a lot of people watching this might be at different stages, some at the very beginning, some later perhaps. But it'd be good for them to understand that journey. To go
Yeah,
into.
sure. It really did start from leaving school, to be honest. So I finished school I did my education in Ireland, Southern Ireland, which the weather is not far off of today's weather, and qualified, or effectively you leave with A levels in Ireland. But I left there at 17. The economy in Ireland is tough, so I was a kitchen fitter for a few years over there, doing 11 hours a day, 6 days a week. But the wages are like €1.10 an hour, so it
Wow.
was shocking. So
Yeah.
saved up, came over to the UK, and I worked in my grandfather's small practice. But he originally just did signage. It wasn't strict architecture, and then over time, more and more people were saying, "Any chance you could put me a drawing together for an extension or a loft conversion?"
Yeah.
Um, and he'd had a few companies himself in his lifetime. Uh, Bless him. The only thing he couldn't do was hold on to the money in them. So he bless him. He went out with what he came in with. But what I learned was pros and cons in business, how to structure finances. There was a lot that I had to learn quite quickly to feed myself. Um, and that was the start of it. So it really was out of necessity. And then I saw a bit of an angle for this fixed fee model, and I'm thinking more and more people are frustrated with the way that this is being done and the norms, if you like, in that space. So I reached out to a few people locally and said, "Is there any chance I can have a free desk?" A good friend of mine now and mentor of mine, his name's Toby. He said to me, just for having the guts to call up and ask for a free desk, I could have one.
Yeah.
So Design Spec was born from a desk in his office. We were there about 8, 9 months, and it picked up enough for me to then take on our own office. 12 months later, we opened our second office, and it really kicked on from there. The beauty of it was fixed fee architecture was wanted, and the product did its own thing. I didn't have to babysit it per se. People really wanted that help. So that's where it came from. That's where it started, and it stays all the way through. Every member of staff that joins us, anyone that speaks to Design Spec, it starts there.
Amazing. Great. And how many people are in the team now, James?
So our head office is where the real activity happens, and collectively in our head office we have a team now of surprisingly low, but we've got a team of about 8 in the main building.
Yeah.
But what we did was we chopped it up into individual roles. So architecture, again, as a norm, is that you have one individual who would quote you, invoice you, work on your drawings, submit your applications. You're expecting them to be good at client liaison. They're very much a bit of everything.
Yeah.
For us to scale and grow, we had to chop it up into individual teams. So we've managed to do it as effectively the sales side, the project management side, and the design side, the actual physical drawings. And that just allows us to have good people at their field, or within their field, and it's allowed us to really set the bones up for where we're kicking on from. And that's the head office, say. Mm-hmm.
Great. Yeah, that sounds like you've thought about that very thoroughly. It sounds like you're set up for scale, because you're right. I think a lot of smaller professional service type businesses will adopt that traditional model of there's one person, you got to do it all. It's your client, you do the whole thing. But actually, the problem with that is you can't scale, can you? You can't bring in 10 new clients next month or 100 new clients next year or whatever, because you're reliant on that person doing the whole thing. So I think that makes a lot of sense. Yeah, and of course that person, how can they possibly be the best at sales and the best at design?
That's it, Graham. I'll be honest with you. The thing that it blew my mind, because naturally you learn on the job, right? So you're hiring people that are presumed to be multifaceted, and they've all got their own quirks or their own downfalls. But then you sit back one day and you go, well, hang on a minute. I am expecting them to be proficient in about 20 fields here. So we chopped it all up, put it into little pieces, and then the simplest saying of all, like we put round pegs, round holes, square pegs, square holes. And even when we're hiring, if someone sits there in the interview and says, I can do all of these things, we'll sit down with them and say, okay, what do you do well out of all of those things? Because I'll be honest with you, I could make you a coffee, but it could be diabolical. So it's okay to say that you'll be doing the tea runs and everything else, but if you're useless at it, I don't want you to do them. It's just as simple as that. And they don't want to do it either. The other thing that is a real, in my opinion, one of the biggest problems is the education system. It trains people to be bang average at everything. If you're bad at maths, they double down on maths. Whereas for me, I've always been a massive advocate that if they're really good at studying English, just study English. We don't need you to be maths. There's someone else that's really good at that. You'll never be at their level because they're just naturally gifted at it. So you stick to your field, they'll stick to theirs. And you have to learn quite early on, I think, in business and in entrepreneurism, that you can't expect everyone to be perfect at everything, and even yourself with those hats. You cannot expect anyone else to want to pick up 20 hats. It's very illogical. So just give them the one, leave them alone, and I've no doubt every single person on the planet can excel in one particular area of their life. Just leave them to it.
Yeah, great. I definitely agree with you on that. Financially speaking, James, when you started, actually very impressive, but it sounds like it was very much like you started with not very much at all. You called for if you got a free desk. Did you, obviously we speak to lots of different businesses. We speak to the businesses that have raised venture capital round, and those that have raised an angel investor round, or those that have raised absolutely nothing and started and sold something and used that capital from a customer to fund the rest of it. How have you funded the business? Did you put any cash in, or was it all completely?
To be honest with you, it started with nothing, and then we've never taken on a bank loan to grow the business. It's all grown organically, all bootstrapped, and we've gone through the cycles. So we went down the angel investor route, we've gone down the bank loans route, we've explored all of them. The biggest problem with it, as I found, was that to be held so rigidly to the outcome was the problem. So for us, we will trial test, trial test. We have a saying up in the office that's put over the wall: fail fast. And I feel like, but I'd love to get your opinion on this, Graham. I feel like in the UK, we are not as, we don't reward taking the risk like they do in, say, America. If you fail fast 20 times, but you win once, you get the pat on the back. I feel that over here, it's more along the lines of, you get one shot at this, give us the numbers, you stick to the numbers, and if you fail, we will take your house. So
Yeah.
it's when I was even speaking to angel investors and they're looking to put FDs on the table, and which is all great, and I understand the logic behind it, obviously. But then when I'm saying, well, this month I want to punt some money on virtual reality
Yeah.
outside of the scope of everything else that we're discussing, or take a punt over here and take a punt over there, that obviously affects your bottom line. And if you're borrowing money, they care about the bottom line above everything else.
Yeah.
So we kept coming back to being bootstrapped. But yeah, I'd love to get your take on that, Graham.
Yeah.
Do you agree, or do you think that we're actually not as risk adverse as maybe I think we are?
No, I think yeah, it's interesting because I've been doing this now for a good few years. When I first started working with startups, probably about, I don't know now, 10 years ago or something, when I left the corporate world, it was much more risk averse than it is now. Slightly better. It's slightly
Okay.
better, but compared to, like you said, the US, it's just like it doesn't. There's no comparison. So you're right. In the US, you are kind of encouraged to fail fast. Especially in the venture capital game. It's like
Yeah.
fail fast, like figure it out. Everybody knows when you start a business, especially if it's very revolutionary or tech or whatever it is, really. In fact, any business, there's a massive chance of failure. Like something like 19 in 20 businesses fail or something from startup. So they know that in the US, like, and venture capitalists know we're going to put some cash behind this business, and most likely it's not going to work, but it might, and that's the mindset that they have. Whereas in the UK, you're absolutely right. It's like, if I give you this money, tell me about the return. Like, I'm going to invest in your business now. What return do I get? Well, hang on a second. It's still just an idea. I can't really give you that, to be honest with you. I can give you
Yeah.
the size of the market. I can give you like some ideas, but don't hold me to that. And I think it's very
Mm.
much our conservative nature as being British, UK, Europeans, perhaps. Maybe it's our history. Um, it's started kind of like we're fighting with the entrepreneurial game, if that makes sense. Like, we want to be
I
very conservative and invest to get a return rather than
I think you
actually
just
invest.
nailed it, Graham. I think that's the best way of putting it, is that it does feel as though financially we wrestle against the term entrepreneurism.
Yeah,
By its sheer nature, it's all about risk, and the
yeah,
only thing they're trying to do is risk management. Now, in my eyes, it should be more. It just needs to, even if it's not completely flipped upside down, but we got to move the dial a bit. To
yeah,
say that we're trying to remove 95% of risk in entrepreneurism is literally using the chocolate teapot to make your hot drink, right? It
definitely.
doesn't, they don't go together. Another thing that I studied, I spent a lot of time studying Toyota, a lot of Eastern companies,
Yeah,
and you take China, for example, a lot of their business models are based on 100-year life cycles. So how different the mentality is. If I said to you now, I'm building Design Spec for 100 years versus I'm going to give you a quarterly review, you would
yeah,
laugh at me on the quarterly review and say, well, why are you even bothering wasting your time on this? Like, surely we catch up every 10 years or every 5 years. We don't
yeah,
need quarterly reviews because they're going to be irrelevant. Um, and I found that really interesting when I started diving into how different countries do business. I
yeah,
thought, well, no wonder why they have some companies that can be massive successes, because you look at is it Sony or Samsung? I always get them confused, but one of them started by just doing repairs on radios, and you're thinking, well, they were given the space to evolve. And same in America, Amazon selling books, they're given the space to evolve. They're allowed
yeah,
to run negatives for 10 years before
yeah.
turning a profit. So
I
that
think it
was
was
then
Sony.
coming, yeah, right. And then coming back to Design Spec, I was studying all of that, just thinking to myself, well, do I really want to spend my time in a very in a very UK minded financial growth pattern, probably not. I also would have found it quite boring, if I'm honest, just to be reporting on this is what we do. We don't venture outside of it, but it's profitable. I was at an age where I started the company at 21 years old. We were looking at raising that money probably when I was 23-ish. And there was a lot of ageism in that space as well, where they were looking at me going, well, to be brutally blunt, James, we don't trust that you can build the business. So we have to put a financial director, we have to put a managing director, we have to put all these things alongside you, and we'll help you build your business. It just that didn't excite me at all. Whereas if I fell flat on my face running at 1,000,000 miles an hour, it sounded kind of cool.
No, I get that completely. And I think I've looked into this quite a lot and read a lot about it and researched a lot. And just think it's kind of also that our conservatism around risk and management for financial returns in like a sort of shorter term horizon, 5-10 years or something, is almost kind of also what made Britain successful in the past as well. And a lot of countries that have tried the whole boom and bust thing, like we're going to go for it, we'll spend loads of money on X, Y, Z. It can work, and I think in the US it worked. And if you go back in time, you look at Silicon Valley and technology and stuff like that, it actually worked for them. If it didn't work back then, perhaps it would be a different story right now. And I think that's the thing. It's just the UK. It's worked for them in the past, but we have to adapt that. And I think there's obviously is more appetite for risk in the UK, but I don't never say never. But I don't think it's ever going to be what it is in the US, to be honest with you. So
No, I agree. I think as well, because the UK really leans on its financial sector for all of its income.
yeah,
If I dare be that bold to say it, but now that we've closed the mines, we've closed a lot of the other large revenue streams, we're relying on central London to prop the whole country up. So I suppose that's one big difference as well, is that in America you've got tech, you've got steel, you've got so many different industries, right? So
yeah,
you can have Google go bust tomorrow and the economy can still survive. Whereas if we lost some of our 2 or 3 largest insurance brokers or finance providers, we would get hit so heavily. So I can understand the regulation around it. Another question for you at the moment, is there a clear standout option for businesses that do want to grow in terms of finance right now that they should be looking into? Is it angel investing? Is money cheaper at the moment? What do you think?
yeah. I think obviously that it depends. It depends on the type of business and the market they're going into and what they're building. But let's talk about, because obviously like venture-backed businesses get all the press, unfortunately, but they're like 5% of all the startups and companies that exist, or something, or maybe even less. So let's just talk about normal businesses, that are providing a service or maybe building some software now because of AI actually really helps with that stuff. Or let's just say they're not going down the venture capital route; they're building normally. Um, I do believe that debt is always hard at a startup. To be honest, like getting a bank loan or something, a debt is tough. There's those small startup loans, like there's a Virgin startup loan and stuff. Great, it's up to 25K, I think. They're okay. You can't do that much with that really if you're starting a software company, for example. Or I think with a service company, you probably can. That would go quite a long way. But if you're really looking to raise money, I do think the UK. One thing I would say around, and I think this was probably about 15 years ago now, probably even more, 20 years ago, they introduced this SCIS and EIS tax scheme. So they've recognized that investors are risk averse and they're not really wanting to put their capital at risk. So why don't we create this scheme called SEIS and EIS, which basically mitigates some of that risk. So we're saying, the tax man, HMRC, is going to take on some of that risk, is kind of what they're saying there. So, if I invest 100K in your business under SEIS, I get 50K back from HMRC. HMRC is basically underwriting a lot of that risk. And I think that's a really good scheme for people looking to raise from angel investors. I actually believe if it wasn't for that scheme, I think the startup scene in the UK would be a fraction of what it is today. And I don't think it'd be as easy to start a company. So I think that's a good scheme. I'd agree
Yeah,
with that.
I agree. We had a look into that as well, and it's in my opinion the one reason maybe that there's still money in the startup space.
Yeah,
Without that, if that was taken away, you're relying on private equity probably because the
yeah,
risk is so high.
Yeah.
Yeah, that's a good shout. And then what about things like credit cards, bank loans? Because of base rate being that much higher, and let's be honest about it, interest rates are probably where they should have been. It's just
Yeah.
that we had historic lows.
True.
But
Yeah.
with everything costing as much as it does right now, do you feel that that's ruling people out of credit cards and bank loans, or is that going to come back soon, do you think?
I think loans are a really good way of financing the business that is already started. Like you've started and you're trading and you've got some traction and perhaps you've got customers, you've got revenue and ideally like some operating profit or something. Even if you're reinvesting in growth or something, that you can show that the business is profitable based on what or whatever it's delivering to its customer. In that situation, I think the debt situation is great. I do, though. I've definitely seen, and again over the 10 years I've been doing this, and even more so before that, the sort of decline of banking relationships. I think if you go back 15, 20 years, a business would have a related, even if you're small business, like tiny business, you've been going a couple of years, you've got some money coming in, you would have a relationship banker that you could pick up the phone to and speak to, and they would actually help you obtain the finance you need via a bank loan, whatever, via some government supported scheme. That's gone now. Unfortunately, you're just on a phone line or you're on a chatbot, so it's much harder to acquire the sort of the bank loans for your business needs, because it's very much black and white now. It's like, well, show me your financials, show me your bank statements. Oh yeah, thanks. Here's what we can offer you. Before, it's more relationship based. The relationship manager would get to know your business much more, get to understand your goals, get to know you as a person, and that would help them inform their credit committee when lending. So that for me is a shame because I think that's disappeared a lot, and I don't know the stats. So I'm interested. I should look at it whether debt financing, per sort of like per company has increased or decreased. I reckon it's probably decreased, mainly
Gotta
because
be.
of yeah, and
Yeah,
some
gotta be.
some of the bigger customers that I work with, we do have banking relationships, and they are fantastic because they really do help when you need that loan, for growth. They help. They do the work for you with the bank. They take you through credit committee. And so that's, for me, I think that's something if we definitely need to keep in the UK, if we can get back to that. If banks can get back to that relationship-based lending would be fantastic,
I couldn't agree more, Graham. We've got a relationship manager, but a very quick story with it is that when we were pushing for that originally, there was a turnover limit with Barclays of 400k turnover for a business, and
Yeah,
then this was before COVID. Then I remember the goalpost moving to 1 million. Then I remember when COVID struck, it all moved to online, and you didn't get the option of relationship. Then
yeah,
it was relationship, but in a team. Then I mean, the goalposts have moved every year,
yeah.
right?
Always getting bigger and
So
bigger.
it just kept moving. Now that we've got a relationship manager, you are spot on. I cannot highlight how important it is to have someone that understands their own system. Not,
Yeah,
they don't bend the rules. All they do is say, by the way, this is the form you need to fill in. This is
yeah,
how you do it. Give me
yeah,
this information. This is the outcome. When you
yeah,
don't have that, like you say, you're on the phone for an hour at a time just trying to get the question answered. You
yeah.
can't run a business. You can't. You're definitely not going to raise finance because you're scared. You're petrified that you'd filled the wrong form in.
Yeah, absolutely. And I think that's because it's just not very lucrative for banks investing in
Yeah,
startups or SMEs. They'd rather do the big stuff, and mortgages and that sort of stuff. So I think that's unfortunately how it is. But I think the government should really think about that because I think they're missing a trick there. I think that
I
would help
agree.
a lot more companies.
One thing that we've been doing, which hopefully helps some of the audience, is genuinely just pulling together other entrepreneurs. So
Yeah,
the sayings are obviously out there, and everyone tells each other how lonely entrepreneurism can be and it being in business. But the reality is, I think it's because we're guilty of just setting that environment up. So
yeah,
for 5 6 years, I just had my head down, didn't speak to anyone about anything, and you have a bit of an ego about it. And it's like, well, that person's doing better than me, and
yeah,
it's all very difficult to get your head around. But the more that you're in business, you start to realize, hang on a minute, I could tell this person exactly what I turn over, exactly where I'm at. I can tell them all the problems. They hold zero judgment because they've either been there as a bigger entity or they're on their way there and want to know the pitfall. There's
Yeah.
no judgment.
No, no.
It's all internal
Great.
for all of us. And if any of us can help each other, it's the
Yeah.
first thing that all of us do. I've
Yeah.
traveled from Essex to Winchester, so whatever that was, 2.5, 3 hours, to help a friend out for a whole day on his business, just to crack open the egg. He'd bought this, long story short, he'd bought this business. He'd
Yeah.
invested his life savings into it. A big problem came up about 6 months in. And I said to him, like, I'll travel down, we'll spend the whole day together, clear the entire diary for both of us, and we just sit in that room until this problem is solved. And like, one of the best days of my life. I love the fact that I was able to just sit there and bounce ideas and help him. And thank God we found the
Yeah.
solution. Like, it was all fine. But
Yeah. Yeah.
that's the
Community.
space. Yeah,
Yeah. That
that's the
community
space.
element is so important, isn't it? Yeah. I think
Yeah,
that's massive help in success as well as a founder, is having that community around you, or some people call it the kitchen cabinet of different advisors and mentors you can just pick up the phone to and bounce ideas off. It's massively
100%.
important. If you haven't got that, actually, I think it's probably largely impossible. Um,
Yeah, I agree, and I think that's what's got to replace some of that relationship manager. So
yeah,
one cry I have to everyone in business is just you got to start building them relationships. Offer to go spend a day in their business. Offer whatever you can to anyone. Um, and it's amazing now. I think they're different doors, right? So once upon a time, you had your relationship manager, and it was quite closed doors. The staff didn't know about numbers. Staff didn't know how well the company was doing, and that was very normal. We've, as a company, for us, I can certainly speak for us, we've gone the other way. So everything's open. We do a weekly catch up, or sometimes it's bi-weekly catch up with our whole team. We present all the numbers of the company. We tell them exactly where we're up to, where we need to be targeting, and they're fired up. They get more geared up by that, and to go ahead with the next week or 2 weeks until the next catch up to try to hit some of these targets. And it's a big collective effort. When you don't have the relationship manager and you're not looking for, you can't really rely on debt at the moment.
yeah,
Just rely on your own team, rely on your own resources that you do have. I'm a big believer in business that, first of all, everything's in cycles. So at some point there will be a bank out there that go back to the old days and say, look, you can have a relationship manager, you're going to have the lending, we're going to go right back to what it was. And I can't wait for that. But in the meantime, what do we have? Well, we have staff, we have teams of people that we can all get together, really get our heads together and say, right, if we can't pull in external funds, let's do what we can internally to multiply more funds. And that's the
yeah,
cycle that we're in at the moment. I think you
yeah.
just got to open the doors up to your staff.
Life of an entrepreneur as well, isn't it? Solving problems and and empowering
100%.
your team to solve the problems. So, yeah,
Yes.
absolutely. Yeah,
Yes. We don't really, I think, again, one of the nature of the beast is that you're worried, and all of us have been burnt. Like we've all got crazy stories about being burnt. But if you can get over that and you can just keep them doors open for the staff, majority of human beings, I really do believe this, 99% of human beings are great people.
agree.
Great people. Just
Yeah,
let them be, give them the chance.
yeah, totally agree with you. 100% agree with you on that. On that point,
Mm.
actually, you mentioned, James, that you're very open with your financials, your reporting, etc., with your team internally. Just to go a bit deeper on that right now, what is actually the sort of one or number of handful of financial metrics that you use to manage your business? Because you've built a business in a bootstrap way with no external funding, which is very impressive, and you're doing a lot of business. What do you look at? What are the financial metrics? What can our listeners learn from you in terms of how to manage your business financially from a
Yeah,
founder
I
point?
mean, I'd also love to get your take on this, Graham, because you've probably seen way more options than I have. Well, you definitely have seen more options than I have. But we go. So we've tried all of it. We've had financial directors, we've had internal accountants, we've had internal bookkeepers. So we've gone from the very top to the very bottom. We've tried and tested a lot of it. I
Yeah,
will be honest with you, most of those statements, and I'm going to go completely against the grain. Most people say you've got to have really robust P&Ls, weekly reports, make sure that all the numbers per week, that you're dead on top of your numbers. I personally go the other way with it. I think there's only one or two numbers that really matter, and the rest is all in your energy as a company. Um, Again, probably maybe a little bit more American or even Eastern in terms of my mentality around it. Don't be too reserved about your numbers. Be more reserved. Are you still delivering a great product to as many people as possible? Because that
yeah,
sort of looks after you. End of. Um, the numbers that matter to us, other than a P&L, there's not much else that we look at, and a P&L, profit and loss, but very top level. Like I'm talking either weekly or monthly, where me and Sam, the general manager, will sit down and just make sure that the numbers are on it. So, for example, if we were charging £1,200 for loft conversions, is that still profitable today? Have wages increased? Has the office increased? Are there is either a fixed cost or a variable cost caning us this month? And if so, is that a common trend? Is it a non-common trend? Just very, very basic. We don't look too close. The main reason being is, in order for us to fail fast, we can't spend hours on end. How did last week do when we've got the following week in front of us? I'm also a diehard stoic. So everything for me is that you quite literally, you die when you go to sleep and you wake up a brand new person with a brand new day. And the opportunities of today are completely different to yesterday. So I won't be wedded to how bad was it last week when this is a brand new opportunity that we've just been gifted and we're ready to go again. So yeah, we're not as, and we should be. I think most people can do better on their finances. I'm also not really a numbers man myself. Sam is, but I'm a bit more idea driven. I come up with a lot of the ideas in the business, so I want to be trialing and testing. And as long as it's generating a profit, which is basically the oxygen of that business, then I'm quite happy to keep testing.
Yeah, but I think, and that makes a lot of sense. There's a lot of founders out there that are not finance, have a finance brain or background or whatever, and that's actually quite very normal, right? Because actually most
Yeah.
finance people don't start companies. But what you said is along the same lines I was going to say. Like, I think in your business, probably the most important thing to keep an eye on is your gross profit margin. It's the same in a lot of business, and maybe all. How much are you selling that thing for? So you're selling that spec for a loft conversion, like you said. How much is it costing you to deliver it, and what's left over? And that is really just that's the lifeblood of your business. If unfortunately it costs you more to deliver that job than what the customer's paying you, then as you know, it's pretty basic, isn't it? You're going to run your business into the ground. So that's probably the most important number for your business, the most important part of your business, right?
I would agree. I think I don't like the word think. I know as well that in business, if you've set it up wrong on day one, you're obviously bound to fail, right? So one piece of advice I absolutely would give is, and I was only lucky with this. This wasn't like a thunderbolt moment that I came up with, but when we started the business, it was, how do we create fixed fee? So I sat at the dining table, what's the utopian solution for homeowners? So I said unlimited designs, fixed fee, and if you had a one-to-one person to walk you through the journey. So the fixed fee was tough. It was tough because design is full of variables, and it tied in with the unlimited designs. If I said to you now, we're going to do your loft conversion for this much money, automatically you've got unlimited designs. So although I split them out, technically they go together.
Yeah.
And the only way that we could make that work was working out the average amount of revisions. So I sat down, did the numbers on it, and worked out, right, okay, so this many revisions equals this many hours of work, and if I'm paying staff, this is what the cost is. And we know at Design Spec that as long as our average preliminary design stage, so the amount of revisions that we do for people, is less than 7, then it's profitable. Yeah. And this had a lovely side effect. So when we were then going down this journey of the pricing, how do you get projects to complete with less than 7 revisions? All we did was effectively guide people in the right direction. If you leave it very open-ended and you say to people, shall we try this, shall we try this, shall we try this, then first of all, they will obviously take you up on that because they're not the experts per se, not to be rude to them, but on average, people extend their home once in their lifetime.
Yeah.
So if we were guiding them through and we say, look, we've trialed and tested this 100 times in the company, we know that this is the best result. Staircase over staircase, bathroom to the back corner, don't use the pitched area because the shower was really tough. Like, there's a lot of guidance that comes with doing so many projects.
Yeah.
So we were able to guide people through up until beginning of this year, and because we do the numbers every 6 months or so on this, our average amount of prelims as a company is 2.4. So when you say what metrics do we look at the amount of average prelims. If that was to hit 7 or 8, we know now that we're no longer in profit. As long as the average prelims sit at 2.4, we know that we're a profitable business, and it's pretty straightforward from there on.
Yeah, fantastic. Yeah, that makes a lot of sense. That's how you manage your gross margin, and what that main metric of gross margin is, that, isn't it? But that's translating, which is really important for us to do in business as well, is translating that accounting jargon, financial jargon, to what it actually means in the business. So, okay, what's your gross margin? Okay, for people that actually don't work in finance and they run their department in the business, how many prelims are you doing? As long as it's less than 2.4, we're good, and they can work with that. And it's the same. It's ultimately the same thing. Gross margin, number of it kind of translates into the same thing. But it's making it real for that person that's working in the business, and that's the magic. That's what a good CFO, a good finance person, a good founder, should help the business do. I agree with you. Really good, James.
Yeah, I think you've got to sometimes ignore the noise as well, where it's easier for people to say, be on top of your finances, really go through your accounts, go through your expenditure. But if you're an expert in accounting and finance, of course that would make sense to you. Yeah. You've nailed it there. I really do believe that most founders, most directors, they're first of all to find the headspace to sit down for say 2 hours and just do numbers when there's so many fires to put out is a tough gig. And it's not something that I could do, that's for sure. I do lean on my team to help me with the numbers. But again, if you've got a bit of an open door and you're encouraging people to help you grow something, then I don't see the problem in letting them excel in their field. And even with our main office here, they kick me out all the time. I have no problem with that. I say to them, if I'm disturbing you, I'm throwing too many ideas, I say to my general manager, me and Sam will have many conversations, and he'll say, James, go work from home today because you've got a lot in your head and it's only going to slow the team down. They know what they're doing. Leave them to their piece. I've got it from here. And I think open dialogue is another thing that helps all directors and founders.
Yeah, massively. But yeah, you're right. Like everyone says, look at your finances. What does that mean? Because you could just look at your P&L. Let's say we look at the P&L now and we say, do you know what, revenue is a bit low compared to what we wanted it to be. We planned revenue to be higher. Let's go and get more revenue. Makes sense, but you're looking at the output rather than the activity that's actually going to make that happen. And so how do you go to, we want to get more revenue? Well, actually, that means we need to have 10 more conversations next month with people or something, which means we need to do X number of ads. I don't know. It depends on how the business works. We need to run ads. We need to improve this ratio on ads or whatever it is. All of that translates into that number on the financials, doesn't it? So it's almost like you said earlier, those other metrics are kind of more important because the numbers look after themselves. As long as you're looking after the main drivers of the business, those drivers are so much more important.
I'll give you another one. Another really good one that worked for us as well. We have a saying in our office that is team first. And I can't remember who I stole this one from, but basically, if you look after your staff and the staff are very happy, the clients will be even happier. There's nothing worse than when you call through to a call center and you speak to someone on a Monday, you ring again on the Tuesday, and on the Tuesday, the staff member goes, I don't know who you spoke to yesterday, but they're an idiot. That's not what we do at all. You lose complete faith in the company, you lose complete faith in everything that every individual is telling you within the company, and you're more likely to go elsewhere. Versus, you empower your team, you do as much social activity as you can, you really get them to gel as a unit. Someone calls up, I spoke to your colleague yesterday, they said X, Y, and Z. What you need your staff to be turning around saying is, well, they would have done everything in their power to help you and to get you to where you need to be. Let me speak to them first. Let me put 2 heads together instead of 1, and we'll come back to you today with the right answer. In fact, within the next hour. And you get that by getting the right culture, having the right human beings in a room. And that has been unbelievable for us, especially in our trade, because we have to communicate a hell of a lot. There's a lot of regulation. There's a lot of time. It would be the same for yours, I have no doubt. And although you'd love for people just to trust you with it, you have to communicate. So there's going to be times where you've got to just keep bouncing and bouncing until you all agree on the topic.
This is a good one I always like to ask, and you can be as open here as you want. You don't have to be. But what's the one kind of financial decision you regret in your business, and what did you learn from it?
Probably not being aggressive enough early enough on staff. Um, I think that it's easier to be a solopreneur than it is to venture into entrepreneur. And what I mean by that is when I was about 21, 22, so I'd started the company at 21. When I was about 22, I was about a year in. I felt like, I don't mean any ego with this at all, but I felt comfortable with being solopreneur, but I didn't know that that's what I was.
Yeah,
So I felt like, yeah, great. For the first time in my life, I'll never ever forget the first ever time that we had a chunk of money in the bank account and I'd already paid the bills. It was like from the age of 12, I hadn't felt that. So
amazing.
it was crazy that I got to that point. I remember calling a mentor of mine and just saying like, I can't believe it, but this is the point that I'm at, and this is wild. And this mentor actually turned around to me and said, James, that is a very embarrassing amount of money. I can't believe that you would call me and celebrate the way that you are. It makes me feel sick, and you need to get your head down and seriously start working. And I remember being absolutely soul crushed, but I bounced it around a little bit with them, and I said, "Well, hang on, like, surely this is doing well." And he's like, "No, no, no. You started at -5. You're just about to get to zero. Don't celebrate zero. You're not even off the starting block, mate." So that really gave me a kick up the backside. And then he kept going, and he said, "Look, don't call it. You're not a business owner. You're not an entrepreneur. You're not even close. You're a solopreneur who has barely got off of zero, and you need you need a reality check." And then I started deep diving into solopreneur, entrepreneur, like what do these phrases really mean? And it was about a year in where only then did I start to consider staff. But Jesus, did the life change once you start actually embarking on that? And I prefer the journey. I much prefer the journey. Although the money's easier as a solopreneur, you
Yeah,
get stuck, and it can be quite comfortable to just, wake up when you want. You can tell people to get stuffed if you want and all the rest of it. To build a business and to have people rely on you for their food and their wages, whole other animal.
yeah,
But certainly a better life to live, in my opinion.
yeah. I agree. Yeah, interesting. So you kind of wish you did that a bit sooner. You delayed it by a bit, but you got there in the end. And I think one thing we can all say, can't we, around leading teams and hiring people and stuff, is you learn a lot about yourself. And it's one hell of a journey, that's for sure.
It's
Because you
so
don't
different.
really know how to do it. Yeah,
It's there's a lot of people out there that I wish. The other thing as well, someone showed me this, and it's the best way of looking at it. When you're hiring, you tend to look at the annual wage, but
yeah,
that's not a true reflection of who and what you're doing. You pay people per month, and they have an opportunity within a month to bring in the money to cover themselves. So it's all wired backwards. Even when you're putting up job adverts or you're looking to hire, nothing should be based on an annual basis, in my opinion. I think it's all based on if you bring in X amount of money per month and their wage is X amount of money per month, that's it. Don't go beyond that because that God forbid they could fall ill 3 months in. You may not want to take the business in that direction 3 months in. You could have a multitude of changes. To
that's
get
it.
to a year of hiring the same person uh, is its own victory, right? As Gary Vaynerchuk always says, hiring is guessing, firing is knowing. So
Yeah,
if you're doing everything on a guesswork anyway, why are you looking at a 12-month lifespan of that individual? They may not like you. It just may not
yeah,
be a great fit.
yeah,
So yeah, people like I was guilty of that. I'd look at an annual wage and think, Jesus, how the hell am I going to pay that? But it's scarier on a 12-month basis. It's a lot more manageable.
on
It's
a monthly basis.
yeah, one step at a time. Yeah, 1 month at a time.
Yeah, absolutely. Yeah, great. Oh, thanks for that, James. I really appreciate all the insight you shared and openness. And do you have any questions for me that we haven't covered?
Yeah, yeah, yeah. So I definitely want to know one of those questions by retiring as
Yeah.
well. That was a great question. One financial regret of yours. Is there anything that jumped out to you, or even from your client base, right? Because you would have seen this way, you would
Yeah.
have had so many more experiences
Yeah.
than me.
Cool. Yeah. Good. Yeah. Good question to find back. Yeah. My biggest financial regret in business. I think maybe it is not one thing, but it's a constant thing for me because trained as an accountant originally, worked in finance, and then became an entrepreneur. I've been trained to think like at the very start of the conversation where we talked about British sort of conservatism when it comes to finance and investing. I've been trained in that basically for quite a long time, and so for me that's just a constant wrestle all the time, with optimism and pessimism and sort of balancing the two. My brain just feels like stretched all the time. So that's
Yeah, I can
for
believe
me, it's
that.
like figuring that out and actually making the decisions, taking the risk fast enough rather than being overly conservative. I think is probably one thing for me. I think, if it's funny because in some ways it puts me in really good stead because we, I know that we're always going to be good. Like we're never probably going to run out of money. Everyone's going to get paid. Everyone who works is going to get paid. They're going to get their salary. Everyone, they've got a job. We'll maintain it. We'll keep it going really well. On the flip side of that, perhaps we could have grown faster if I was slightly more risk taking. Um, so that's the payoff, I think, and obviously that's something I will never know, and we'll never know. But yeah, that's something I wrestle with all the time, that conservative and pessimism. But maybe that's what every founder does, and that's the balance. That's the balancing act, isn't it?
It is, and I think that's a good point there. I think friends and family as well, they always have your personal interests at heart, which means conservative. Don't grow
Yeah,
too quick. Don't take too many risks. You've got it good. You've got a car. You've got a house. You've got whatever.
yeah,
Why on earth would you risk it? And it's like,
yeah,
because I can't take any of it with me. The game is the game. I
it
love
is,
playing the game.
yeah, yeah,
It's the best. It's the best thing on the planet. Like there's nothing that gives you as much yin yang. And I think for me, balance is everything in life. Like you're always up and down. And I love the idea that work-life balance only truly matters if you are having to balance, right? If your work is your life and your life is your work, and you can get that blend of the two 24/7. Like when I'm away on holiday, I enjoy working on my laptop.
yeah,
I just enjoy it. I work on different things. I might come up with different business ideas. I might bounce around with my team. I might
yeah.
want to pick the phone up and video call them because we're all friends as well
Cool.
within our business. Yeah, right. So if you've built the culture right and you've built an environment where you're open with each other and you're getting that space, I've always felt that is the better way of having it anyway.
Yeah,
Um,
yeah,
Another question, if I may,
yeah, please.
we're super active in mergers and acquisitions at the moment. So we bought a couple of companies. We've
Great.
got another one lined up for next year,
Yeah,
and it's our growth plan now. So we were growing at your 7 to 9% at the size of our company, which apparently is fairly normal, and it's a good growth rate for where we were at.
yeah,
But for me, it was too slow. So we've identified that we can buy companies at the moment with vendor finance. So we buy companies no money down.
yeah,
We structure them slightly differently each time, but we can buy a business basically where it absolutely helps retire the owner of the business. And from our perspective, we can roll that into our existing empire. And a lot of it's vertical integration. So now we offer a new service, but to the same client base. The value per client goes up, and then its profitability is obviously looked after as a result.
yeah.
Is there a world that you recommend, Graham, or a lender that you recommend that anyone in the M&A space should be exploring to raise more money or to have more discussions with business owners in
Yeah,
M&A?
yeah, interesting. Well, I think, yeah, well, first of all, James, I think that strategy is popular, isn't it? For good reason, because you're right. And obviously, you're being strategic around perhaps different locations and different markets, because a lot of what the customers you serve probably are like local. They like, there probably is this big local thing. I like to do business with. If I'm going to get my house, like it's a once in a lifetime extension, like you said, I want it to be with someone that is around the corner or something I know and my friends have used and stuff. So I think that's probably where, if you really want to expand, you've got no choice really to do it through M&A. You could open an office in a new town or a new city, but you're starting from zero. You've got to build all of that brand equity. Whereas you could just buy something that customers already know and love, and
Spot on.
bolt it on and go from there. So it's very common for that reason. There's also a lot of, as we all know, boomers generation that come into retirement that want out now. They've been running their business for God knows how many years. They want to slow down and retire, but they've got a really good business and they've got lots of customers and stuff. And they actually need someone like you now, James, to come and bring it to the next level. So it's a perfect fit. Sometimes, some of these things go wrong quite often in terms of people overpay. So that's generally the one thing I've done quite a bit of M&A in my time. One thing that I would say, the reason why it can go wrong is overpaying, because people look at it in a very sort of optimistic way. So it'd be like, well, actually, yeah, we'll buy it, we'll bolt it on. All of those customers that they had will stay. The team will stay. We'll just merge the two things and off you go. And then you get into it, and you're like, well, actually, the culture of that office is so different to the culture of this office, and it's too difficult to merge, and we just can't. We're going to have to think of plan B, and you're doing fixed fee, and the customer wanted something else, and so that customer goes somewhere else now because they actually don't really like doing business with the new parent owner and stuff. So those things all need to be baked into the valuation, into the price you're willing to pay. You really do have to. It's kind of, again, it's balanced, but allow for that risk in the sort of valuation of the company you're looking to acquire. And then, like you said, the great thing about this, which I think lots of people don't know, is seller finance. Which lots of people, their only way out really is through seller finance. They want to sell their company. There's another company wants to buy it. They haven't got the cash on the balance sheet because no one really carries all that cash on the balance sheet. And so what you do is you say, well, actually, we'll acquire you, and then from the profit that your business is generating, we're going to pay you off every year for the next X number of years, 5 years, 10 years, 3 years, whatever, with a bit of an upfront payment. And it's a fantastic mechanism, to be honest with you. It's absolutely amazing that it's the best way of acquiring businesses in this stage. With smaller practices, smaller businesses, smaller firms. Now, the other people that you asked about where to go for financing, I think the best place to go is your bank for some of it, for the down payment, but seller finance. Seller finance is the best option here, hands down.
I'm pleased you said that. Yeah, I agree. We're basically putting the minimum amount down, working with our existing bank, and then the seller finance works. It works too well. Also, another thing we found, Graham, is that and we can actually pay in seller finance. Another thing that a lot of people don't realize is that you can pay less interest, but to the seller.
Yeah.
Right. So at the moment, most lenders want 4 or 5% above base, something in that region, depending on security and depending on obviously the 1,000 boxes that you go through. But even if you said 4% plus another 4%, you're looking at 8% minimum on that kind of finance.
Yeah.
You could turn around to the seller and say, we'll just say that the payment's 500,000. You can turn around to them and say, look, I'll give you 5% on your money, but you lend it to me.
Yeah. I'll give you base rate or something. Yeah, exactly.
I'll give you the base rate. Yeah. And from their perspective, it's also a lot safer. So we've done a big deal, a really nice deal where we're buying this business, incredibly profitable. It's an amazing, amazing business. They've done a great job. They've been running it for over 20 years. But like you said, they just don't want to do it anymore. And they were very honest with me. They've bought all their toys. They've got their houses. They've got their retirement pod. What they want is to enjoy it, and they have no interest in spending the next 30 years continuing. So they've set themselves up right, and now they can go off and enjoy it. What they need is someone that they trust, and you build that trust, and that someone that they believe if they throw the keys to these people, their staff will be looked after, their brand will be looked after, and the best thing they can do is look after the legacy. So we can offer them a little bit more money, but on a monthly basis. If you have a bank knocking on the door for, let's say it's 25,000, 30,000 pounds a month, and you miss 2 payments because that business has just gone through its natural blip, they could not get any more of their money. So seller finance has been amazing for us, and I'm pleased that's what you basically agreed there. That's the way.
It just has to be right for both parties, doesn't it? And the good thing is for the buyer as well, it offers that bit of protection, because in the deal you would also build in things like, well, actually, if we only manage to retain X amount of the revenue, then the price gets adjusted, and we'll adjust that in the price, and therefore in the seller finance. So it gives that protection to the buyer as well. which is great. Which touch on that point of risk around these are the things that can go wrong when you buy a business. But actually, we also want to probably incentivize a little bit the ex-owners to sort of keep their foot in a little bit for a period of time, just to help with the transition and make sure, and it's in their interest to do so as well, because if they do that, they're going to get a better price ultimately. So yeah, it's the best approach
100%.
by far. Now,
Yeah.
if you're looking to do much more though, James, like say you want to bolt on 10, 20 practices, over 50 over a period of time, private equity are very interested in consolidation in these sorts of arenas. So they often look at things like practices like yours, accounting practices, even dentists, that sort of stuff. There's quite a lot of cash available in private equity to fund those types of strategies.
That makes
So
sense.
that's something, if you wanted to go bigger in the future, that's something to look at, definitely.
And do you recommend when you move into that PE world, that private equity world, is that all rapport based these days? Do you really need to build a strong rapport with that provider,
Um, I
or are
think
they
so.
very numbers driven?
No, it's definitely worth building the relationship over a period of time. To be honest with you, I think relationships always go far. They are numbers driven, though. Definitely numbers driven. So it's going to be, you know, if we acquire these practices, what's the upside? So ideally, if I buy that practice for £1 million as private equity, I really need that to be worth 1.52 million to me by either, there's some synergies, and that synergies are things like, well, actually, we put the two offices together, we can save costs because we don't need two finance teams, we don't need two whatever teams, or we've got customers over here that want to buy from this office over here as well, so therefore we've got some upsell opportunities and so on. And when you build all those into the business case, that's really what private equity is interested in. How do we buy it for £1 million, but really it's worth 2 million to us, in 2 3 years time?
Yeah. I find as well that for years people were moving their money out of their business and maybe buying property.
Yeah.
I think the world is flipping a little bit in the sense of you can get very creative with M&A. And like you say there, you can buy a business that vertically integrates. You're increasing your profit on your existing business. You're now selling new services to their
Right.
client base. And it's pretty, like you say there, a lot of people, I think, when you're starting out in M&A or you're doing your research and people go, you're paying $1 million, but day one the company's worth 2 million. It
Yeah,
sounds unrealistic, but it's absolutely the way that you can work it.
absolutely. Yeah. Oh, great. I'll tell you what, James, we should probably do in the future, maybe if you're open to it, maybe
Hmm.
we should do one of these conversations, but specifically on M&A or something, and go through some of the stories there. Because you
I would
bought
love
some
to.
stuff already. Have you bought some stuff already?
Yeah, yeah. We bought. We've got two engineering companies and we've got a quantity surveying company that we're doing at the moment.
Yeah.
Um, the quantity surveying will effectively be a merger because we've got a quantity surveying business, but the structural engineering side was brand new for us. We have no engineers at Design Spec, so yeah, we managed to open those doors up, and yeah, it's been amazing, man. Like it's so good. We can now sell architecture, structural engineering, even the builders, because Design Spec Connect through that business, we also connect families to contractors. So we're extending that conveyor belt all the time. As you can imagine, in architecture, the difficulty is the cost per lead is high. It can be 150 quid for us to acquire someone.
Yeah.
So we need that conveyor belt to be as long as possible for
Yeah.
us to make the money that we need in the business for growth.
Yeah.
And growth to us now, especially with seller finance. So we spend a long time on the negotiating, which in M&A everyone tells you is the wrong way to do it. But when you're starting out, no two ways about it. Put all of the time into the discussions. And both times now we've managed to buy the business with no money down, 100% seller financed. And as I say, one of these companies is unbelievably profitable. It's an amazing business. They had a lot of interest. But because we were willing to constantly travel to them, put the time into building that rapport, I was very honest and open. I had open conversations about all of our finances. I showed them absolutely everything about our business. And I said, the reason I'm willing to show you everything is that I want this business for the next 20 years to be bigger and better than what you guys have even got it to now. I'm going to need your guidance. I'm going to need to lean on you. And I was just very honest about the whole setup. I'm not a structural engineer, but I want this business to succeed. And they turned down some more lucrative offers. There was people offering them over £1 million up front in cash. So, they turned that down because the money wasn't the big thing for them.
Great.
Which is nice, right? It's good to
Really
know
good.
that we've got something there that people are happy to be part of.
Yeah, great. Well, some really good experience, James. They would definitely love to pick your brains on that in the future. Yeah, that'd be
Yeah,
great.
be
Yeah,
more than
amazing.
happy to jump back on.
Yeah, sounds good. Well, I think actually that was a great conversation. We're probably out of time.
That
Thanks so much. I appreciate the time, James, and yeah, really, really good conversation.
Thank you so much.